The market functions as an inexorable crystalline mirror, yet the overwhelming majority of traders avert their gaze from the unflattering truths it unveils. They convince themselves that their daily endeavors involve nothing more than scrutinizing intricate charts, interpreting the subtle language of candlestick patterns, and manipulating streams of quantitative data. In reality, however, they are engaged in a profound confrontation with the labyrinthine depths of their own consciousness. Their primordial fears that lurk in the shadows, their voracious greed that devours rationality, and their insidious impatience that erodes every calculated move. This revelation underscores why the psychological supremacy, often termed the mental edge, stands as the paramount determinant of success in the treacherous world of trading. And herein lies the raw, unpalatable truth that precious few traders dare to acknowledge. Two individuals can apply the precise same methodological framework to the identical chart, synchronizing their actions down to the very second. And yet one will ascend to consistent profitability, methodically building wealth, while the other descends into financial oblivion, systematically dismantling their trading account through a cascade of avoidable errors. The chasm between them transcends the superficial elements, the technical configuration of the trade, the reliability of the brokerage platform, or the ephemeral fluctuations dictated by the time of day. Instead, it resides squarely in the intricate neural architecture of the mind that ultimately summons the courage or succumbs to the hesitation to initiate the trade. This immutable distinction has, since the dawn of speculative markets, delineated the elite cadre of profitable traders from the vast legions of perennial losers. To illuminate this principle, reflect upon the landmark experiment orchestrated in 1982 by Richard Dennis, the visionary commodities speculator, through his iconic Turtle Traders initiative. Dennis harbored a fervent belief that the art and science of trading could be distilled into a teachable curriculum of explicit rules, accessible to anyone with the discipline to follow them, whereas his business partner contended that true mastery demanded an elusive, inborn aptitude that no instruction could impart. In a bold bid to resolve this philosophical impasse, Dennis scoured society for uninitiated recruits, ordinary souls such as bartenders pouring drinks in dimly lit establishments, security guards patrolling quiet corridors, and individuals hailing from disparate socio-economic strata, all utterly devoid of any prior exposure to financial markets. He bestowed upon them his meticulously crafted trading system, a compendium of unambiguous directives, and even entrusted them with substantial portions of his personal capital to put theory into practice. The results were nothing short of revelatory. A subset of these novices not only adapted but excelled, alchemizing modest seed money into vast fortunes amounting to millions. Conversely, others faltered spectacularly, incinerating their allocations in a blaze of missteps, despite ostensibly operating under the exact same parameters. The enigma persists. What precipitated such diametrically opposed trajectories? The culprit was not the unpredictable gyrations of the market itself, nor any inherent flaw in the system provided. Rather, it was the participants' divergent abilities to uphold those rules when besieged by the relentless barrage of emotional upheavals. Fear that paralyzes, greed that blinds, doubt that undermines. This experiment laid bare a timeless axiom. Mechanical rules, no matter how robust or empirically validated, are rendered impotent without the underpinning of psychological fortitude. They serve as mere scaffolding. The true structure is erected or demolished by the trader's inner resolve, at the very nucleus of trading success. Lays this elusive mental edge, a sophisticated perceptual filter and behavioral repertoire that empowers profitable traders to maintain equilibrium amidst the cacophony of market pandemonium, while their counterparts disintegrate into disarray. Permit me to articulate this with uncompromising bluntness. If you neglect to subdue the tumultuous forces within your own psyche, you will orchestrate your own downfall with precision, long before the market's impersonal mechanisms have an opportunity to intervene. The archetypal losers in this arena are characterized by chronic patterns of self-sabotage. They dither indecisively at moments demanding swift execution, impulsively chase illusory opportunities when strategic inaction is warranted, and escalate their risk exposure twofold or more, driven by an intolerable aversion to conceding defeat. These individuals operate as unwitting puppets, manipulated by thestrings of their unbridled emotions, irrespective of whether they possess the self-awareness to recognize this enslavement or remain blissfully oblivious in denial. This dynamic encapsulates the grand, tragic irony permeating the trading landscape. The majority of practitioners perceive themselves ace exemplars of enlightened rationality, meticulously crafting decisions grounded in rigorous logic, comprehensive analytical scrutiny, and unyielding discipline. Nevertheless, the moment tangible capital is imperiled, the instant the abstract transforms into the visceral, that illusory veneer shatters irreparably. What erupts in its stead is a primal deluge, the visceral terror of monetary erosion, the paralyzing fear of forgoing a potentially lucrative move, FOMO in contemporary parlance, or the narcissistic imperative to affirm one's intellectual prowess and infallibility. By profound contrast, those who consistently extract profits from the markets inhabit a radically reconfigured mental paradigm. They are neither mythical titans impervious to human frailty, nor detached cyborgs devoid of sentiment. They acutely register the lacerating pain of a losing position, the intoxicating adrenaline surge of a triumphant streak, and the insidious temptation to amplify bets beyond prudent limits. The critical differentiator resides in their painstakingly honed capacity to intercept and redirect these impulses, channeling them into constructive outlets rather than destructive detours. When confronted with a setback, they issue the vortex of revenge trading, wherein one ill-advised position begets another in a futile bid for redemption. Instead, they internalize the loss as an inescapable toll exacted by the probabilistic nature of the enterprise, a mere statistical inevitability in the grand tapestry of outcomes. Similarly, a string of victories does not engender delusions of omnipotence, prompting haphazard increases in position sizes or deviations from protocol. It is regarded as a neutral data point, reinforcing adherence to the system without altering its parameters. In periods of market torpor, where prices meander aimlessly in consolidation phases, they resist the siren call of boredom-induced fabrication, fabricating trades where none exist. They cultivate the art of vigilant waiting, comprehending that forbearance is not passivity, but a potent skill, akin to a predator's stealthy ambush rather than frantic pursuit. Crucially, this fortified mindset is not an innate endowment bestowed upon a select few. It is the fruit of intentional, iterative cultivation. Much like an athlete's conditioning regime or a musician's daily scales, the analogies abound in realms beyond trading. Yet few are as apt as the domain of professional poker, where psychological parallels run strikingly deep. The preeminent players at the felt do not commandeer the most favorable cards in every dealt hand. Their supremacy derives from an unflinching commitment to probabilistic play, executed with monastic discipline, utterly unswayed by the emotional wreckage of a bad beat, that cruel twist where statistical superiority yields to improbable misfortune. Trading embodies this philosophy verbatim. Enduring profitability does not necessitate prophetic omniscience or unerring predictions. It demands the adoption of the casino's dispassionate vantage point, as opposed to the gambler's feverish volatility. Casinos exhibit no perturbation when a patron secures a substantial payout at the blackjack table. Their architectural advantage is predicated on the inexorable mathematics of long-term aggregation, where edges compound across infinite iterations. Profitable traders emulate this institutional mindset, perceiving the market not as a capricious foe to be outwitted or a benevolent genie granting wishes, but as an agnostic ecosystem of fluctuating probabilities, where individual outcomes are ephemeral noise amid the signal of sustained edge. The fatal misstep afflicting the preponderance of traders stems from their ingress into the market laden with fallacious preconceptions. They covet expeditious opulence, insist upon ironclad certainties in an inherently stochastic domain, and harbor an egoistic compulsion to emerge vindicated on every speculative foray. These pernicious desires infiltrate the decision-making apparatus like an insidious virus, corrupting judgment at its core and precipitating cascades of suboptimal choices. A trader mired in loss mentality initiates a position with their gaze, fixated on the hypothetical bounty, the imagined riches that could materialize. Consequently, each infinitesimal adverse tick in price registers as an existential torment, amplifying discomfort to unbearable thresholds and prompting premature exits or erratic adjustments. In diametric opposition, the profitable counterpart engages the identical trade with a lens attuned to actuarial probabilities, procedural integrity, and the uncompromised execution of their battle-tested plan. An adverse resolution does not impugn their core identity or erode their self-efficacy. A favorable one does not incite hubristic overreach. This equilibrium may appear elementary in theory, yet its practical attainment is a Herculean feat. For the market possesses an uncanny proficiency in probing and exacerbating your most entrenched psychological vulnerabilities. If an aversion to fallibility defines your character, the market will administer iterative doses of humility until the lesson permeates. If an obsessive need for dominion over chaos governs your disposition, it will relentlessly demonstrate your fundamental powerlessness amid its whims. If an addiction to adrenaline-fueled excitement propels you, it will dangle the bait of overtrading, luring you into a vortex of hyperactivity until your capital reserves are depleted and your mental reserves shattered. This pervasive phenomenon elucidates the staggering attrition rate in trading. Failures proliferate not due to the scarcity of efficacious systems. Viable methodologies abound in literature, in forums, but owing to the endemic deficiency in mental resilience required. To withstand the ceaseless internal skirmishes, visualize, if you will, a scenario wherein two traders, having immersed themselves in exhaustive chart analysis, converge upon the same emergent breakout formation. Trader A proceeds with clinical precision. Entry is effected. A stop-loss barrier is erected at a predetermined threshold, and the position is allowed to evolve autonomously, unmolested by meddlesome interventions. Trader B replicates the entry, yet ask price recoils a scant 5 pips, a negligible fluctuation in the grand scheme. Their psyche erupts in panic. They abort the trade precipitously, only to observe from the sidelines as momentum reverses and propels price toward their original target. Consumed by a cocktail of frustration and regret, they impulsively enter at a deteriorated price point. The market, ever the trickster, orchestrates another retracement, activating their stop and crystallizing a needless loss. As the trading session concludes, Trader A tallies gains, their account bolstered. Trader B confronts deficits, their equity diminished. The setup was indistinguishable, the mechanics carbon copied. The sole variable was the psychological fortitude to navigate the interim volatility without capitulation. Venturing into even more profound strata, profitable traders internalize an emancipatory insight that perpetually eludes their losing counterparts. The market is an entity of absolute neutrality, devoid of sentience, malice, or benevolence toward any participant. It harbors no awareness of your personal narrative, your aspirations for financial independence, your latent fears of inadequacy, or your meticulously crafted life goals. Traders ensnared in loss cycles anthropomorphize this abstraction, attributing conspiratorial intent to unfavorable movements, as though the collective forces of supply and demand conspire explicitly to thwart their endeavors. This paranoid personalization breeds distortion, clouding judgment and fostering irrational responses. Profitable traders dismantle this fallacy. They perceive the market as an impartial conduit of data streams and probabilistic flows, a canvas upon which patterns emerge and dissipate without prejudice. By relinquishing this egocentric lens, they liberate themselves to engage with unadulterated clarity, discerning opportunities and threats with objective acuity. This detachment begets a counterintuitive paradox. The diminished emphasis on per-trade validation paradoxically enhances the frequency of correct calls. The attenuated emotional investment in isolated outcomes paradoxically elevates aggregate performance over extended horizons. The perennial query arises: how does one construct this impregnable mental fortress? The discomforting response eschews superficial remedies. No assemblage of inspirational aphorisms or self-affirmations suffices. No mere incantation of discipline conjures it forth. Instead, it demands a regimen of systematic conditioning, analogous to the progressive overload that sculpts physical musculature. It materializes through iterative exposure to stresses, the deliberate cultivation of tolerance for discomfort, and the habitual practice of non-reactive observation amid turmoil. Profitable traders forge this armor via the crucible of lived experience, augmented by rigorous practices such as comprehensive trade journaling, not merely logging entries and exits, but dissecting the emotional undercurrents and cognitive biases that influenced each decision, and exhaustive post-mortems of missteps, wherein errors are mined for transformative insights until named as visceral lessons, inoculating against recurrence. Losers, by contrast, habitually flee from this introspective discomfort, opting for denial or deflection, thereby perpetuating stasis and forestalling growth. This dichotomy extends far beyond trading's confines, serving as the universal differentiator among high achievers in athletics, commerce, and even the intricate dance of human relationships. It transcends raw talent or accumulated knowledge. It hinges on the alchemy of transmuting pressure into fuel. The trader endowed with a mental edge interprets stresses as diagnostic signals, harnessing them for refinement. The deficient counterpart buckles under equivalent loads, fracturing irreparably. The quintessence of this discourse distills to a concrete imperative. The mental edge is no ethereal construct, but the tangible proficiency to actualize your statistical advantage without succumbing to emotional usurpation. Every trader mired in consistent underperformance intellectually grasps the requisite actions, adhere to risk parameters, honor stop losses, eschew impulsive entries, yet falters spectacularly when the crucible of real-time pressure intensifies. Every ascendant trader contends with parallel temptations and trepidations, but has engineered a reflexive override, ensuring alignment with protocol prevails. This demarcation constitutes the proverbial line in the sand, the threshold across which destinies diverge. Therefore, as you prepare to confront your next chart, pose this introspective query with unflinching sincerity. What will truly dictate the resolution of this impending trade? The empirical patterns etched upon the screen, or the insidious narrative unfolding within your cranium? For if you fail to assert dominion over that internal voice, it will inexorably assert dominion over you, and therein resides the tragic fate of the trading majority. Obliteration, not from intellectual paucity, but from the yawning void where mental edge should reside. There exists an intrinsic, merciless authenticity woven into the fabric of financial markets that the average trader assiduously avoids confronting. Your empirical results serve as an unerring reflection of your unvarnished self, not the eclectic strategy scavenged from anonymous online forums, not the sophisticated indicator pulsating with algorithmic allure on your trading interface, but the raw, unfiltered essence of your character, complete with its flaws and fortifications. This immutable reality elevates the mental edge to the status of supreme arbiter, the inexorable force partitioning the domain of enduring profitability from the wasteland of habitual defeat. The disconcerting veracity demands acknowledgement. Replicate the experiment with two traders employing indistinguishable systems, synchronizing their entries with metronomic precision, and observe the bifurcation. One accrues capital with steady, compounding grace, while the other ignites a conflagration of self-induced catastrophe, reducing their account to ashes within weeks. Identical trades, congruent setups, harmonized risk-reward calculus. The rift? Not in scholastic aptitude, not in cognitive horsepower, but in the sovereignty of mental governance. Traders perpetuate self-deception through obsessive tinkering, perpetual entry optimizations, exhaustive historical simulations via backtesting, and the quixotic pursuit of an infallible perfect system that promises immunity from adversity. Yet this Sisyphean labor merely deflects from the authentic adversary, their own undisciplined psyche, riddled with emotional volatility, hasty judgments, and impatient urges that systematically undermine every initiative. Profitable traders inhabit a divergent cognitive ecosystem. Their entire conceptual apparatus for navigating risk, assimilating losses, and orchestrating executions is fundamentally re-engineered, calibrated for resilience rather than fragility. Without this neural reconfiguration, no quantum of erudition or tactical acumen will avail. You'll inexorably recurse through vicious cycles of boom and bust until both your financial reserves and psychological stamina are utterly depleted. Introspect upon your personal annals. How frequently have you discerned the optimal course? A crystalline setup aligning with your criteria. Protocol dictating a modest 1% capital exposure, only to veer catastrophically off script, plunging all in on a whim. The rationale. Your mind fabricates a narrative of uniqueness, deeming this time an exception to immutable rules. Or consider the instances where you've truncated profitable positions prematurely, liquidating winners at the first hint of pullback, only to spectate as price surges inexorably toward your initial projection. Not a deficiency in strategic design, but a profound fissure in mental architecture. Profitable traders secure victory in the antecedent psychological theater, fortifying their resolve for impeccable execution well before market validation materializes. They diverge at the foundational level, conceptualizing trading as unglamorous toil, a vocational pursuit devoid of romantic allure, rather than a cinematic shortcut to extravagance. Their objectives eschew the allure of spectacular home runs in favor of protracted endurance, affording their probabilistic edge ample temporal latitude to manifest and compound. They form no sentimental attachments to individual positions, nor do they indulge in fanciful projections of opulent futures. Their cognitive bandwidth is monopolized by flawless execution, not ephemeral outcomes. Losers, ensnared in delusion, frame trading as an existential panacea, a high-stakes lottery ticket promising emancipation from mundane constraints, a portal to the ostentatious lifestyles flaunted on social media. Each trade becomes freighted with the gravity of these fantasies. Losses transmute into personal indictments, drawdowns into existential failures, errors into intolerable burdens. Detachment remains an alien concept, perpetuating a cycle of emotional entanglement. A loser, incapable of tolerating incremental erosions, escalates wages in a bid to preempt minor setbacks. A winner normalizes such erosions as the routine overheads of enterprise, the unavoidable dues paid for participation in a game of edges. This philosophical pivot enables survival, and survival begets the alchemy of compounding returns. The market requires no active agency to vanquish you. You'll obligingly self-administer the coup de grace through vengeful pursuits, egregious leverage mice applications, or obstinate retention of hemorrhaging positions, all rooted in an inability to concede error. With each infraction, you erode not merely your capital base, but the foundational pillars of your trading psychology and long-term viability. Profitable traders, acutely cognizant of this insidious dynamic, erect prophylactic barriers, meticulously curated habits, ritualistic pre-trade routines, and draconian disciplinary frameworks that insulate them from their own baser instincts. They don't gamble on discipline manifesting spontaneously amid crisis. They architect systems that render it inevitable, embedding safeguards against emotional incursion. Draw the analogy to the disciplined soldier. Preparation is exhaustive and antecedent to conflict. Responses under duress are drilled to autonomic levels, transcending conscious deliberation. Profitable traders mirror this ethos, conditioning their psyches through simulated adversities and repetitive drills to thrive in the maelstrom of market chaos. Losers, akin to untrained civilians thrust into combat, improvise haphazardly, hoping for fortuitous outcomes, a strategy that invariably culminates in rout. Their paramount advantage crystallizes in profound detachment. The market serves no role in ego validation. Personal identity remains hermetically sealed from transactional vicissitudes. This emancipation facilitates unencumbered action, entries devoid of trepidation, losses severed with alacrity, winners permitted to flourish unimpeded. Losers, conversely, remain shackled by egoic chains. Trades assume personal dimensions, adverse candles interpreted as affronts to dignity. The compulsion to affirm rightness supersedes the imperative of profitability, a tragic irony, given that winners endure frequent inaccuracies, their asymmetrical victories eclipsing cumulative defeats. They prioritize unswerving consistency over fleeting precision. Pause now before embarking on your next venture, and conduct this self-audit with surgical honesty. Do you engage this pursuit as a consummate professional, anchored in process and probability, or as a speculative gambler, perpetually beseeching serendipity? Are you fortified with the mental edge to navigate as a steward of systems, or do you cling to illusions of miraculous windfalls? The market, impartial arbiter, will inexorably unmask the verity regardless. And consider this: the mental edge defies superficial imitation. You might simulate confidence transiently, mimic discipline for a fleeting interval, feign patience during benign conditions. Yet when the market unleashes its full fury, volatility spikes, drawdowns deepen, temptations amplify, your authentic self emerges unbidden. Absent genuine fortification, fracture is assured. Trading's humbling essence derives from this exposure. Presumptions of inner strength dissolve under scrutiny. Disciplinary pretenses evaporate amid greed's onslaught. Patience unravels in boredom's grip. When the facade crumbles, the market extracts its tribute indifferently, proceeding unabated. The mental edge transcends motivational transience, discarding ephemeral hype or pre-session pep talks. It manifests through the erection of habitual bulwarks that preclude sabotage, protocols so stringent that emotional breaches find no ingress, environments engineered to render discipline reflexive rather than elective. Losers recoil from such constraints, yearning for the spurious liberty of momentary whims, bypassing rules when intuition deems it obvious, indulging impulse unchecked. This very indulgence seals their fate. Profitable traders voluntarily relinquish this counterfeit freedom today to harvest authentic liberation tomorrow. Financial autonomy born of compounded consistency. Thus, when dissecting the gulf between victors and vanquished, divert your gaze from superficial artifacts, charts, entry methodologies, systemic architectures, and penetrate to the cognitive core. Therein unfolds the authentic theater of conflict, where mental edges are laboriously forged and fiercely defended. This psychological resilience serves as the anchor amid tempests, the differentiator segregating the elite 5% who endure and prosper from the 95% who succumb and retreat. No quantum of intellect or strategic sophistication compensates for its absence. It constitutes the non-negotiable prerequisite for entry into this unforgiving domain. Without it, you are consigned to obsolescence. With it, you unlock the potential for sustained thriving. It is oft proclaimed that trading comprises 90% psychological warfare and a mere 10% tactical mechanics. Traders may nod sagely in agreement, yet their observable behaviors betray the inverse, an obsessive fixation on strategies, indicators, setups, and signals, while the psychological dimension, the true saboteur of fortunes, receives scant attention. When defeats accumulate, the post-mortem seldom indicts the system. Invariably, it traces back to lapses in self-management under pressure. This is where the mental edge asserts its dominance. The demarcation between those who harvest consistent profits and those who perennially hemorrhage capital is not access to arcane strategies or proprietary secrets. Rather, it resides in the winner's unflinching self-honesty, their willingness to confront internal distortions, contrasted against the loser's unwitting propensity for self-delusion. The market operates as an impartial reflector. It does not fabricate your emotional states, but mercilessly exposes them. Greed begets amplified greed. Fear spawns paralyzing fear. Indiscipline invites chaotic repercussions. Yet the profound insight eluding most is this: the market's volatility does not alter the chart's objective reality. It merely amplifies the subjective lens through which you perceive it. One trader discerns opportunity in a configuration that induces panic in another, not because the data diverges, but because their mental scaffolding diverges profoundly. This razor-sharp psychological differential is the fulcrum upon which survival pivots against annihilation. Envision two traders fixated on an identical graphical landscape. Price teeters at a pivotal resistance threshold. The first trader interprets it as a harbinger of breakout confirmation. Their respiration steadies, their strategy crystallizes, their risk parameters are etched in stone. No haste, no anxiety. They embrace the defined exposure with equanimity. The second trader, surveying the same juncture, experiences physiological distress, palms slicken with perspiration. Memories of yesterday's setbacks flood the forefront. An urgent compulsion to recoup losses dominates cognition, intertwined with visions of triumphant vindication. Their focus fragments, ensnared by historical regrets and futuristic fantasies rather than present exigencies. The entry is made. The breakout falters. The composed trader shrugs philosophically, executes the predefined exit, and pivots serenely to the subsequent prospect. The agitated trader unravels. They augment the faltering position in denial or prematurely liquidate only to re-enter erratically, culminating in an account's inexorable erosion. Identical visuals, congruent data points, disparate psyches yield disparate destinies, such as the embodiment of the mental edge. Yet the disquieting axiom persists, one that traders evade at their peril. Cultivating this edge demands neither superior intellect, fortuitous serendipity, nor esoteric revelations withheld from the masses. It necessitates the arduous unlearning of the cognitive fallacies your mind perpetuates amid market immersion. Deceptive narratives like, "just this once," "I'll bend the rules for this exceptional setup," or "if I endure a bit longer, the tide will turn in my favor," or "this singular trade holds the power to redefine my trajectory." The sophistries seduce with momentary solace but accrue devastating tolls over iterations. The mental edge entails real-time vigilance, intercepting these distortions, deconstructing them ruthlessly. and supplanting them with unyielding truths, irrespective of the attendant discomfort. Losers gravitate toward psychological comfort, beseeching the market for reassurance, certainty, and validation in every transaction. Winners, however, acclimate to discomfort as a constant companion, recognizing that trading's essence is uncertainty incarnate. They do not await the dissipation of fear or doubt before acting. They execute resolutely amid the din, embodying self-mastery in its purest form, not dominion over the market's caprices, but sovereign control over one's responses while the market unfolds autonomously. Trading's humbling brutality stems from its capacity to lay bare life's latent deficiencies. If impulsivity plagues your existence, the market will magnify it exponentially. If instant gratification is your vice, it will exploit it mercilessly. If gambling's thrill captivates you, it will ensnare you in its web until ruin ensues. This exposure is neither gentle nor forgiving. It's exorbitantly costly, exacting penalties in capital and confidence. Profitable traders are no superhumans. They've traversed this inferno, permitting the market to incinerate their illusions, greed's veracity, revenge's bitterness, desperation's myopia, ego's arrogance, and emerged resolute, vowing never again to cede control to these specters. Losers perpetually evade the flames, scavenging for expedients, externalizing culpability onto markets, brokers, or fate, ensuring perpetual stagnation. Intriguingly, the boundary separating loser from profitable trader is not immutable. It oscillates with each micro-decision in the arena. Every instance of rule adherence, despite siren temptations, propels you toward the victor's enclave. Every concession to fear or avarice relegates you to the loser's domain. Transformation accrues not via grandiose epiphanies, but through myriad incremental acts of discipline layered cumulatively. This process lacks glamour, absent from social media montages, manifesting in mundane virtues, the restraint to abstain when setups falter, the selectivity to pursue only pristine opportunities amid a sea of mediocrity, the humility to absorb modest losses without egoic escalation into calamities. Such banality repels the masses, explaining the paucity of mastery. Losers seek market-derived affirmation, intellectual superiority, illusory control. Winners relinquish these cravings, fixating on procedural excellence over episodic triumphs. This perceptual inversion constitutes the mental edge, indifference to per-trade vindication, viewing each as a mere datum in a protracted sequence. Imagine the liberation, losses shrugged without recoup imperatives, adverse movements accepted as probabilistic roles in an enduring game where edges crystallize over horizons. This ethos animates the top percentile, acknowledging singular uncertainties while banking on disciplined longevity. Peril lurks in the market's intermittent reinforcement of vice. Rule infractions occasionally yield profits, fostering delusions of genius and entrenching recklessness. Winners discern this trap, repudiating lucky windfalls that erode discipline, gauging progress via process fidelity rather than outcomes. Resilience emerges as the linchpin. All traders endure anguish, trials, barren spells, but survivors remain unbowed, eschewing panic or spirals, leveraging setbacks for calibration without systemic abandonment. Monetary detachment amplifies this, conceptualizing in percentages and probabilities, treating capital as instrumental rather than ego-reflective. Obsessive dollar fixation breeds reactivity. Detachment breeds rationality. At the bedrock, the mental edge orbits identity. Losers self-identify as gamblers chasing euphoric highs. Winners as prudent risk stewards, entrepreneurial custodians of a trading enterprise. This reframing alters trajectories. Gamblers court volatility's extremes, business owners prioritize preservation and sustainability. The market remunerates the latter, castigates the former. Thus, the mental edge amalgamates habits, convictions, and viewpoints, accruing subtly yet potently, embracing uncertainty sans resistance, privileging plans over passions, normalizing losses as procedural elements, favoring patience over haste, resilience over despair. These elections compound into an ostensibly intangible advantage that manifests in tangible disparities. Losers intellectually apprehend these tenets, yet falter in embodiment, emotions eclipsing reason. Winners, not inherently brighter, excel in application. The arena is cerebral, not graphical. Edges are internally cultivated, losers eternally quest externally. This acceptance catalyzes trading's latent promise. Two traders, congruent charts, one profits via self-mastery. Markets remunerate composure amid frenzy. The verity, failures arise from knowledge, surplus sans emotional governance, cognitive battlegrounds yielding hesitation or recklessness. Analogized to bestowing a Lamborghini upon an unlicensed novice, spectacular wreckage ensues. Mastery resides in discerning non-action, Theopek's skill of inaction. Cerebral wiring craves predictability. Markets thrive on ambiguity. Attempts to impose order culminate in self-annihilation via stop manipulations or risk inflations. Acceptance of indeterminacy liberates from fear, stabilizing trajectories. The pleasure-pain dialectic ensnares losers. Entries pursue ecstatic wins. Losses inflict agony, prompting impulsive escapes via further gambles, a perpetuating spiral. Winners rupture this by decoupling from highs and lows, recasting both as impartial feedback. Losers leverage trading for existential rectification, desperation contaminating choices with impatience and blindness. Winners, pre-fortified in resilience, approach as expository mirror, not remedial salve. Trading unveils not mends. Impulsivity, greed, fear, laxity surface promptly. To ascend the 10% echelon, redirect obsession from tactics to mentality. The true adversary resides internally. Conquer self. Markets yield invincibility. The authentic schism between consistent victors and market casualties transcends indicators, methodologies, or commoditized online secrets. It inheres in cognitive processing, win-loss assimilation, self-regulation amid graphical turmoil. Psychology's profundity is underestimated, overshadowed by charts' allure, news clamor, setup seduction. Yet the war wages internally. Losers unwittingly self-combat, depleting accounts repetitively, scapegoating externals. Winners navigate identical sentiments, temptations, brutalities, but respond transformatively. This responsorial variance is the mental edge, elucidating the elite minority's triumph. Contemplate two traders before congruent visuals, candlesticks, averages, zones identical. One engages, disciplines hold, risks managed, profits secured. The other engages, panics midway, exits prematurely, re-enters tardily, losses mount. Market unaltered, setup static, mental paradigms diverge. Most losers harbor illusions of a loss-proof grail. Reality defeats integral. Every trader, apex included, loses. Losers personalize failures. Winners proceduralize. Intolerance for error precludes longevity. Edge, not fear eradication, but efficacious trading amid fear. Losers await confidence's advent, futile. As markets perpetually provoke doubt, winners discipline despite uncertainty handling differentiates. Losers demand guarantees, clinging to tools for illusory safety, punished by surprises. Winners embrace, prioritizing probabilities management over oracles. Acceptance unshackles from futile control. Self-sabotage stealthily undermines. Streaks culminate in blow-ups via subconscious unworthiness or risk addiction. Winners process guard, euphoria resistant, despair immune. Psychology savvy thwarts hijacks. Patience deficit plagues losers. Action addiction sidelines aversion. Winners recognize waiting's valor, missing preferable to forcing. Patience yields clarity. Impulsivity, exhaustion. Resilience bifurcates. Drawdowns trigger loser spirals. Strategy shifts. Overtrading quits. Winners anticipate, evaluate, adjust, sans core abandonment. Setbacks propel winning resurgences. Pain avoidance stunts, resilience cultivation. Money detachment pivotal. Winners percentage probability, long-term oriented. Losers dollar obsessed, reactive. Capital instrumental, not worth proxy. Rationality ensues. Deepest, identity shift. Gambler, tourist manager, business proprietor. Gamblers chase extremes. Proprietor safeguards sustain. Market favors latter. Mental edge. Compounded habits, beliefs, perspectives. Uncertainty, acceptance, plan fidelity. Loss, normalization, patience, resilience. Subtle accumulations yield monumental gaps. Losers cognize. Fail, enact. Emotion, logic, chasm, their habitat. Winners adhere. Battlefield mind. Edge self-forged. Market indifferent. Losers external hunt. Winners self-master. Truth evaded, market blame easier than self-confrontation. Acceptance unleashes potential if persisted thus far. Profound gratitude. Channels meteoric ascent, psychology-centric, pondering elevated step, affordable paid discord for real-time nexus. Novices, experts, professionals convene. Strategize, analyze, learn. Psychology master collectively. Valued via fee, not gratis dismissed. No peddled courses. Earnest community elevation. Undecided, your verdict? Comments scrutinized. Resuming, assured trader initiates day rule vowed. Initial triumph empowers. Subsequent loss shifts. Recoup compulsion overrides. Impulsivity cascades. Account ravaged. Bedtime rage, self-directed, ubiquitous tale. Adversary internal, not external artifacts. Poker virtuoso. Protracted probabilities. Tilt immune. Discipline parallels elite athletes, soldiers, hits absorbed, resets executed, strategies clung. Single outcome detachment. Positions mere place in marathon. Coin flips. Singular obsessions thwart large number laws. Historical vignette 1995. Nick Leeson, Baring Strader. Initial successes. Reversals prompt doubling desperation. Logics eclipsed. Emotional frailty bankrupted venerable institution. Technical prowessans psych mastery fatal. Contrast Soros. Colossal wins 1992. Bank of England break. Yet greatness in swift loss cuts. Wrong admission humility. Flexibility longevity. Strategies ubiquitous. Mind control scarce. Support resistance ratios. Stops known. Execution falters mentally. Daily quotas doom. Market goal indifferent. Winners rule execute. Outcome accept. Pilot turbulence. Procedural calm. No frenzy fallacy. Wealth begets discipline. Amplifies frailties. Hone modest scales. Loss streaks. Temptation peaks. .com 2000. Bubble fortunes. Luck misattributed skill. Burst wiped holders. Survivors risk rigorous. Reality acceptors. Losses. Market tuition. Plan-bounded teachables. Losers, personalized affronts spiraling. Danger, evolutionary loss aversion. Ancient survival wired death equates loss. Trading reframes, non-fatal process part. Rewire journaling emotions patterns, calm arsenal. Serene focus trumps chaotic distractions. Edge muscular, perpetual exercise. Laziness regresses habits. Market probes patience, greed, fear, control. Self-conquest imperative, profitable, monotonous, disciplined, stoic, losing, thrilling gamble, emotional coaster. Subconscious excitement preference explains failures. Boredom embrace, paradox outcome indifference invites abundance. Edge, self-mastery sourced, chart secondary, journey milestone, chart self-mirror, hesitations, impulses, greed, fear amplified. Breakpoint, quit, scam, blame, or evolve via self-conquest. Battleground, untamable market versus strategy-armed hordes. Daily engulfments. 5% thrive via edge, fearless discipline, frustration-free patience, destruction-free humility, forged via errors, sleepless audits, emotional decision bitters, Livermore legacy, market infallible, opinions errant, ego detach, reality align, discipline non-perfection, emotions felt, actions system bound. Losing, fear avoids trades. Winning, fear feels, trades executes. Edge, consistency over comfort. Storm pilot, cockpit quakes. Alarms blare, lightning strikes. Fear acknowledged, instruments trusted, system adhered. Trading parallels, volatility storm. Losses alarms, news lightning, system edge. Mind cockpit, control loss crashes. Patience potency, constant immersion fallacy. Sidelines conserve capital energy for true strikes. Losers force, cracking foundations, sinking vessels. Winners, laziness, non-disciplined conservation, acceptance culmination. Losses inevitable, inescapable. Resist not, manage. Losers, identity assaults, doubt, recklessness, spirals. Winners, business costs, data points, clarity steps. Philosophy, pragmatic survival. Game, longevity over extraction. Losers, rapid burn. Winners, pace, risk, curb, mind reign, compounds reward. Difference, mental fortitude. Market probes edges, dangles, snatches, tempts, punishes. Losers, cycle victims. Winners, illusion pierce. Respect mirror, align sans fight. Odyssey binary. Trade chase emotional masses. Mistake self-destruct or elite few step back. Breathe, edge cultivate. Charts universal. Visions diverge. Market mind exposes. Discipline profitable lost. Separates. Arena beckons. Tomorrow charts reopen. Millions are sail, most fall. Query, emotions crowd drag or edge elevate? Yours choice, market perennial. Future, account, mindset, hinge action.